Have you ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions, are able to trade in a fair and efficient environment, have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance, as it is imperative for investors to be well informed in the fast-paced financial world. Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rulebooks of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hello, everybody. Welcome to this webinar that is titled Equity versus Debt Investment, Choosing the Right Strategy for Your Goals. This webinar is brought to you by Bursa Malaysia and managed by our company LifeChamp. My name is Shen Chu. I'm the moderator for this session. So in this webinar, we are going to discuss portfolio asset allocation between equity and debt. So before we begin, a disclaimer, whatever we share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities I mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He is the founder of BBB Wealth. He's also a licensed financial planner by Securities Commission Malaysia and Bank Negara. He's a regular financial commentator on IC TV Mandarin News. He's also the host and producer at City Plus FM. He also served as a financial columnist for Nanyang Xiangbao. He has over 10 years experience in financial investment with strong expertise in macroeconomic analysis, investment product selection, and portfolio construction as well as management. He manages over 30 million ringgit in asset, helping clients effectively manage their wealth. So he's none other than Mr. Anson Tan. Anson, good evening. How are you today?
Hey everyone, good evening everyone. Thank you, Shane.
Yeah, good to have you here today to discuss about portfolio allocation. So without further ado, I will just hand over the session to you.
All right, just give me a few moments to share my slides. Can you guys see my slide? If everything is okay, the camera, the visual, the voice is okay, please give me a one or okay.
Okay.
Yeah, thank you, Shane. Okay, I see a lot of okays and one from the ground. All right, so the topic today we are talking about equities and debt investment. So, um, the moment when I actually decide to talk about these topics is actually I do realize that there are a lot of investors in the market. When they talk about investment, the first thing that goes through their mind is actually what stock should I buy, or what ETF should I buy into, or what kind of unit trust should I actually invest into, but they have no idea how to actually diversify across asset classes. Okay, and most of them, when we talk about equity, they have a lot of ideas. But when we talk about debt investment, they may not know what is that, and what they have in their mind are basically a fixed deposit or perhaps government bond. But they most of them, they do think that government bond actually have a very high entry level. Perhaps you will need few 100,000 or a million, then only you can tap into this segment of investment. So before we actually dive into the core content, here is what you will actually walk away with for today, okay? Whereby I will actually help you to understand the core difference between the two asset classes, between the equities and debt. And also, I will actually guide you through whether how you should actually look at your personal goal and identify your risk profile, then match the right investment strategy, the right inter-asset strategy with your own goal and risk profile. And after that, we will actually explore and go through some of the portfolio examples, then and some of the market cycles impacts, okay, when we are having a different types of portfolio across different market cycles, okay. Then we will also look at it if I'm having a different allocation model for what kind of investors should we actually look into a aggressive portfolio, and at a different life cycle, whether we should consider to switch our portfolio to a more aggressive one or a more conservative one. Yeah. Okay, let's go on to our first part. Okay, so know yourself and your investment goal. All right. So I would say this is actually the most important thing, okay? The most important part when we come to investing, okay? It's not just about picking the right stocks or picking the right bond, but actually you, okay? You are the one that is the key and the most important part of this investing journey, okay? I would say one of the most common mistakes that I see people is that most of them they actually jump into investing without first understanding who they are as an investor. Okay, and here is some of the truth is that no strategy actually works if it doesn't suit your personality, goals, and circumstances. So I would like all of us to pause for a moment and reflect on these four key areas. Whether do you have you actually thought through considering your investment experience, whether you are considered a or a B or a C investor, and what kind of knowledge, okay, or the past experience with investing that you have. And do you think you are experienced enough to DIY your own portfolio? Have you experienced enough bear market or bull market or all sort of market condition? Okay. Then the second one, it would be the time horizon. Whether do you need the money that you are investing with within 5 years, 10 years, or you can actually invest it for long term, perhaps 10 years and beyond. All right. The next one, it could be on your personality. Whether with your personality, you are someone that you can actually swallow the up and downs during different market cycle, because if we really look into market cycles and the market patterns, right, you will realize that we can actually say global equity market, most of the cases, it will go up, you will go up for the long term, okay? But definitely, if there's a crash or a recession, your portfolio or the market can also go down for 20-30% during a year or two, okay? So if that's the case, can you actually withstand this kind of volatility? It's not about taking the losses first. It's about whether you can stand the volatility. All right. Then the next one, it would be on the financial condition, because financial condition also it will restrict your selections, whether you need to stick with the investment, whether you can stick with the investment for a longer tenure or longer period, but or do you have a certain goal, is that, for example, you may need to renovate your house 2 years later, and you may need your investment money. If that's the case, you definitely cannot put it into a high volatility equity portfolio. So it would be the case, we will definitely need to understand our own risk tolerance. Also, we have to understand our goals. Okay, because when we are doing some clients' financial planning, we will definitely need to understand what kind of financial goal our clients actually have. Okay, for example, is it actually a short-term one, or be it is a mid-term one, or actually is a long-term goal that we actually have. Okay, and if we are talking about retirement funds, then it would be a very long-term thing, 10 to 30 years. In that case, you can actually go all out and have a pretty much aggressive portfolio, with a right asset allocation, of course. But if we are talking about it, for example, if right now you are actually at the age of 50, and you may have just a few years down the road, then you may need to consider retire. Then if that's the case, you don't actually have the time for you to stay invested for a long time. So actually, as an investor ourselves, we will definitely need to understand our own goal, and also some of the pointers that I've mentioned just now. All right. So if we do look at this chart, right, I will say most of the time all of us, we do understand the high risk, high return. So it means that there will be definitely a trade-off. If you want a higher return, of course, you need to take a higher risk. But actually, I would say most of the people, they don't actually understand the trade-off between the risk and the return. Actually, when we are talking about risk, right, it may not be you uh it actually may not be the certainty that you will definitely face this kind of losses, but it's actually the that kind of volatility, whether you can actually stand that kind of volatility. Because some people, they may actually want a 10% return, some people they may actually want 15% or even 20% annual returns. But when I ask some of my clients and students whether they can actually handle a 20% losses in a bad year, and I would say most of the people, they will actually hesitate. Okay, so when we talk about the core trade-off in the investment world, if you want a higher potential return, you will definitely have to accept the fact is that you will need to go with you will need to accept a greater volatility. Okay, so if you want the stability or you want a peace of mind, you may actually have to accept a lower return. That's the fact. Okay, so this, and I would say the equity element and the debt element actually showed us a two diverse situation of the case, whereby equity, when we are talking about the world equity, that's mainly driven by the US equity. We are talking about a yearly return about 9% per annum. All right. But when we are talking about the debts portfolio, or actually when we are investing into fixed income, this actually generating 5% annually, that kind of return. So when you are comparing this kind of two different very diverse and very different asset classes, what we need to understand is that the smart move is definitely we will need to have a strategy to match our own risk profile and match the portfolio with the right amount of equity, the right percentage of the debt instrument that we can put into our portfolio to make it the right strategy, the right portfolio for all of us. All right. So okay, I actually inserted a risk assessment questionnaire. So I would actually request all of us here, okay, from the ground, whether if you look into these five questions, whether you are leaning towards the option A or actually option B. Okay, if you have most of your questions towards the option A, then it will be a more conservative one. If you have most of your option towards the option B, then it will be a more aggressive, more long-term approach. So you may look into all these questions and yeah, let me know whether you are an A person or a B person. We have perhaps 15 minutes, 15 seconds for this, yeah. I see some of the audience actually give the response B, reply with B. Okay, some is A. Okay, the rest of us, the rest of you, B. So I see a lot of investors with great appetites, I would say. Okay, I think we see more with B. Okay, so I will say that's why, right, if you actually face through some of the account opening process with some of the financial institute in the market, you realize that they will actually have this kind of risk assessment questionnaire, whereby your remisier, your financial advisor, they will actually ask you some of these risk assessment questions to assess actually whether you are someone that's that aggressive or you are someone that is quite conservative. Because with all these questions, we can actually get the answer whether what kind of risk profile are you really. But I would say typically, when we have the result, most of the case, right, those who actually opt for A and they are typical conservative kind of investors, right? But they will still, when you ask them the question whether you think that a return of 5 to 6% annually that is generating from the debt investment is sufficient for you, will you be happy with it? But most of them, because of the human nature, they will think, perhaps I can take higher risk and perhaps I should get a higher return. Otherwise, I don't think I'm happy with it. Yeah. So that's the thing. When you are actually trading off, okay, when you are actually trading off the risk and the return, most people they will still put their focus on the return itself without actually think about what are the volatility of this portfolio, whether I can swallow it, and that's the thing. So here is some of the key difference between the features of a conservative approach and aggressive approach, okay, whereby you can actually see it from the income generating aspect. The conservative approach, you will actually give you a stable, predictable cash flow. And when we look at all these things, it will be very different. So I would say you will need to understand yourself first before you choose what kind of approach and the strategy that you will need to opt for your portfolio. All right. So next on, let's go on to the next part whereby we will go into uh the elements of the debts versus the equities, okay, whereby when we talk about debts, right, and equity, I will say in actually when we look at the investment universe, most of the investment that we are talking about, they can be they can be actually categorized into the debt and the equity category. Okay, whereby equity category, they actually come with the ownership in the business. Okay, whereby that you are actually lending out money to someone. Okay, so the nature itself is very different. The security for the debt investment is definitely higher when it comes to the the security, because most of the case it may come with certain level of collateral or security compared to the equity, because you are the owner of the business. Definitely it come with higher risk, and it would be more volatile. Why? Because your return are solely depends on the growth of the company. Okay, if the company can grow their profits along the journey or along the years, then definitely the share price can actually grow, then you will be rewarded handsomely throughout the years. Okay, so the nature itself is very different. Okay. Yeah. Okay. So if we look at the equity versus this pyramid that we can see here, okay, common equity shareholders are actually ranked the last, and that's why we are actually rank it the highest risk lah, okay, because this is actually the debt repayment schedule, and or we can call it, for example, if a company are having financial difficulties, right, the first person, it will definitely be the debt holders that we will actually pay them off first. Okay, if the company are facing liquidation, and they will need to liquidate everything and pay it off back to all the stakeholders. Okay, the debt holders, it will be the first one to receive the money. All right. So the senior debt holders with the most of the case, senior debt holders, they actually debt holders that's come with collateral. Then the subordinated debt holders will be the second rank. Then the third one, it would be the preference shareholders. Okay, the preference shareholders is actually it actually have the features of equities and debt, so it's actually a mix or blend kind of features. Okay, then the next one it will come to the common equities holder. It would be the common equities holder. All right. So yeah, hold on. Let's go on to next slide. Okay. So when we are breaking down the investment universe, right? Just now I've actually mentioned there are two asset classes, equities and debt. Of course, there are other uh asset classes, for example, like commodities, gold, or action, or even properties. But the key asset classes that we are discussing tonight, it will be equities and debt lah. So on the equities area, there are a lot of selections or options. Okay, on individual stocks, we have all kind of company stocks that is up for us to actually choose. Okay, and here you can also see private equities, because when we are talking about shareholdings in the company, which is equivalent to the equity, it could be a private company shares, or it also can be a listed company shares. And but of course, in terms of the accessibility, of course, the listed company share will have more accessibility, but private equities is also another options that we can consider when we are talking. So when we are looking into the equity space. Okay, and REITs, equity ETF, equity funds are also some of the options that we do have. Okay, so if we are looking at this area, right, you will actually realize that if some of the options like stocks or private equities, we will definitely need to find the access ourselves and do it ourselves, which means you will need to build the portfolio yourself. You will need to analyze the stocks yourself and think whether and consider whether you want to add on the stocks into your portfolio. But when we are talking about ETF and equity funds, then it will be more towards picking the right ETF with the right exposure, or picking the right unit trust equity funds that can generate you alphas, which mean they can actually beat the equity index benchmark every year. Okay, that can actually generate that kind of alpha, which means they can outperform consistently throughout the years. Then your job, it would be very different. Okay, from the stocks level, on stock picking, you will definitely need to pick the right stock. But when we are talking about equity funds and ETF, then it will be a different kind of work already. Here we are talking about intra-asset allocation. You will need to pick it, for example, at this moment, whether how many percent of my equity exposure I want to go into AI space, how many percent of my equity exposure I want to go into the healthcare space. So it would be very different. Okay, on the other hand, on the other side, we can also see debt. Okay, whereby on the debt side, that I would say the risk-free asset, okay, that we normally call government bonds risk-free asset. And globally, the best risk-free asset, it will be US dollar, US Treasury, okay. Although recently there are a lot of rumors and a lot of KOL sharing that US Treasury US government may face difficulty on refinancing their treasury, but it may not be the case. Okay, so then down the road, we also see the corporate bonds. Okay, that is issued by normal companies. Okay, it could be GLCs like our Tenaga, Maybank, this kind of companies. They actually all do issue bonds. Then or if you don't want to pick a single individual bonds yourself, right, you can also invest into the bond exposure via funds or ETF, whereby you're actually investing into a basket of fixed income instrument. whereby when we are talking about ETF or funds, normally they are actually having 50 to beyond hundreds, okay, fixed income names inside. So when we are talking about that kind of diversification, when you have 50 to 100 names, so you will not need to worry about that kind of default risk lah. Okay, because if you are investing into a single name, default risk is definitely something that you will need to credit risk is definitely something that you will need to pay attention to. Okay, follow after the company news and see whether they have the ability to continue to do refinancing or actually repay your debt. All right. And some of the company in the market, they also do issue convertible bonds. All right. Then P2P lending is also another form of debt instrument. All right, because P2P, peer-to-peer lending is also is actually when we are talking about private debts. Okay, there are actually there's a lot of P2P platform in that's licensed in Malaysia, and what they do is actually they actually acts as a platform to actually provide the avenue for investors and the companies that would like to raise funds to go up to the platform, and then the platform will actually screen through their profiles, their credit ability to see whether what kind of rate that investors should actually be compensated. Okay, if the investor were to lend this company their money. All right, so there are a lot of P2P lending platforms in Malaysia, and these are what we call private debts. Yeah. Okay. So after going through so many slides on our equities and bonds, I would say we will need to come to the reality is that actually, Anson, what kind of annualized average return or estimated volatility that we are talking about? Okay, be it on an aggressive profile or moderate balanced profile, or for the conservative income generating profile. Okay, so we can see from this table, okay, and when we are talking about an aggressive 100% allocation portfolio, okay, the expected return whereby we use the proxy we will use S&P 500 as a proxy, that kind of expected return that we see is actually around 10%. Okay, but when we are looking at the volatility, it will actually be 15%, that kind of range annually. Okay, because technically, if you look through the chart of S&P 500, when market is not doing well and when market is having some recession, actually market do drop 20 over 30 over percent. Okay, so when you average out, 15% is actually the estimated the standard volatility that we are talking about. When we are talking about a balanced portfolio with a 50% equity and 50% debt, that kind of volatility actually reduce, okay, to 8 to 9%. But of course, the expected return will also reduce to the 8% range. Then when we are talking about a conservative portfolio with no equity exposure, okay, with 100% bond allocation, then it actually shrink to 5% expected return, and that kind of volatility that we are talking about annually is actually only about 3-4%. Okay, actually the 3-4% is actually coming from the different market cycle. And when we are talking about fixed income bond, the market cycle is about you have to observe the economy data to understand that at this moment whether the bank and government will need to hike or they will need to cut the interest rate to fit the current economy condition. All right, so the 3-4% volatility is actually quite tiny, okay, when we are comparing, quite minimal, okay, when we are comparing to the aggressive equity volatility that we are talking about, okay, it's at least 4 or 5 times higher. Okay, so this is actually a chart, okay, a chart that is based at 10,000, okay, that's based at 10,000 and in at I think at 1978. Okay, this is actually the MSCI World Index. Okay, the MSCI World Index is representing the global equity market, not just the US or Malaysia or China. Okay, so it's actually the World Index. It actually went up 74 times since 1978. Okay, that's how many years? 22 plus another 25 years. So it's 47 years. Okay, so 47 years, that it actually went up 74 times. And if we average out on the annualized basis, that kind of return we are talking about is only close to 9 to 10%. But if we do look at the chart carefully, we actually see there were major dips in 1990. Of course, this one actually is year 2000, the dot-com crisis, year 2008, the global financial crisis, year 2020, the COVID crash. Then what we also see in the post-rate hike correction in year 2022. Okay, so if we look at it, let me continue with next slide. Okay, if we look at it, actually the annualized return throughout the past 40 years is actually, I would say the more reflective number, it would be 8/9 if we are talking about last 10 years, last 20 years, and the last 40 years. 8/9% it would be more reflective. Okay, so over the last 40 years, it actually returned this kind of numbers. Okay, but we also need to understand and remember every few years, the market also drop 10, 20, or even more than 30%. That's the reason when we are investing, we need to understand that kind of volatility. It may not be necessary our enemies. It also can be our friends. Okay, because if we don't see that kind of volatility, it's almost impossible for us to actually top up into our portfolio regularly. Why? Because uh okay, I actually look at the comment section that Eugene Wong actually say volatility, it could be a fee. So yeah, true, it could be a fee, but actually it could be your friends as well. Because if you don't have this kind of volatility, you may not have the opportunity to actually go into the market, buy into the market when the opportunity emerge, I would say. If, for example, if we imagine if the market only go up like a mountain, okay, then it just gone up all the way, then if it doesn't drop, it actually won't have, we won't actually have that kind of chance, right, to actually top up at better pricing. So it's also very important to remember it's not about whether the market can go up. Every year it will definitely go up 10 or 20%. We need to remember it will also come down, but it's just that eventually it will still go up. So when it fully recover and continue to go, we will need to definitely stay invested, and it will definitely test our patience and test our emotion along the journey. Okay? So the math behind the bond returns. Okay, so the bond returns, the total bond returns are actually made up of the coupon income as well as the capital gain or loss of the bond prices, okay? So when we are talking about the coupon income is slightly fixed. It's slightly fixed because when the bond issue that time, right, just like your mortgage loan that we are the mortgage loan, when you actually borrow the money from the bank, when the bank agree to lend you, they will actually tell you, oh, what's the base rate plus the margin, the spread that they would like to charge, okay, that they would like to charge on your case, on your profile. Then that formula is actually the borrowing cost that you will actually need to pay. Okay, you will need to bear. It same goes to corporates or government when they want to issue a bond. At the day of the issuance, they will actually fix the financing cost. They will actually fix the borrowing cost. For example, for Genting bond, we could be talking about a 5%. For Malaysia government bonds, if we are talking about a 20 years government bond, it could be around the range of 4%. Okay, or for 20 years bond, it could be around the range of 4%. Okay, so they will fix the coupon, the interest that they are committed to repay you every year. Okay, so it's fixed. Okay, but on the capital gain and loss, right, actually it's something that is beyond the issuer control, because unlike the fixed deposit, okay, when you agree to actually lend your money to the bank and you are well compensated with the agreed rate every year. But on the bond prices, it will actually be affected by the market cycle, the OPR rates decision, or the changes of the borrower credit profile, or even sovereign rating downgrades also it will actually affect the bond prices. So it is some of the macro things or some micro things that we will need to pay attention to the company or the government when we are actually dealing with that investment. Okay, just just an example here. For example, when we are actually talking about rate hike in a few years back, because in year 2020 when COVID hit the market, actually data are very bad and economy activities on the ground are not great. Okay, so that time what Bank Negara did, okay, throughout a year is that they actually cut our OPR from 3%, that kind of range, down to 1.75. Okay, so when Bank Negara are cutting the interest rate, it means that the new bond that is issuing, okay, the new bond that is issued, perhaps I will go on to next slide to show you some of the numbers, then you will get what I mean. I will say it will be easier. It will be easier. All right, so let's continue on the example that I mentioned just now. Okay, during year 2020, when Bank Negara actually cut the interest rate down to 1.75, right? Uh, Actually, the bond price and the interest rate will have a inverse, which is a opposite relationship. Okay, when central banks are cutting in interest rate, right, it will actually make all the existing issue bond more attractive because they're actually issued at a higher level previously. So for example, if a government bond that is issued previously at 4% level compared to this level when the Bank Negara actually cut the OPR, right, a new government bond could only give you a annual coupon about 2.5%. Of course, the 4% one is more attractive. So if that's the case, right, bond price will actually pick up. Okay, so here I actually present you a bond fund, okay, a bond mutual fund, and also a bond ETF on my left, a bond fund on my right. Okay, the bond fund is actually Amanah Raya Sharia Trust Fund, whereby you can see, okay, the five, you can actually assume okay, on average, the coupon in the Malaysia bond universe is only about 4 to 5%. Okay, the bond universe, when we are talking about bond, is only about 4 plus 5% kind of return, which is the coupon range. Okay, anything above 5%, it will definitely be the capital gain that we have on the bond prices. So actually the whole portfolio went up another 4 plus percent. That's why in year 2020 you can actually see that this bond fund actually yield or generate a 9% return to the investors. All right, okay. But when when things normalize during year 2021 and year 2022, actually what Bank Negara did is that, oh, I think the worst is actually already, if the worst have already over, we will definitely need to hike the interest rate at this moment to control inflation. Remember, right after COVID, we are talking about inflation globally. It could be partly because of the supply chain disruption, but another thing, it would be also because of the low global interest rate. Okay, there is when we are talking about USN is actually close to 0%. Malaysia and we are talking about 1.75, that kind of rate. Okay, so that time when the Bank Negara, they want to reverse the monetary policy, when they want to hike the interest rate, then bond price will actually come down. When bond price actually come down, that's the reason why in year 2021 and year 2022, we actually see the bond fund actually yielding a not so handsome return, not so great return. Okay, even the bond ETF, we are seeing a similar movement. Why? Because the coupon itself is definitely fixed at 4-5%. Okay, but the ETF and the mutual funds are actually paying back the extra 4% capital gain that they enjoy during the rate cut cycle, which is year 2020. So they will need to when the cycle reverse, the capital gain will actually become capital loss. Okay, so that's the reason why in these 2 years the ETF and the mutual funds the bond funds are actually not generating good returns. But after deducting the coupon, actually you can see it will still give you 1/2%, because the bond coupon is actually 5%. So which means the bond price only drop about 2% for a year, then another 2% for another year. That's the reason. Okay. Then when things normalize, we are seeing back a 5-6% kind of rate again. All right. Okay. So when we are talking about a model portfolio for a different risk profile, okay, the whole focus that we have today is definitely on the inter-asset allocation, whereby we will need to decide how many percent of our fund we will need to put it into the equity space, how many percent of our fund we will need to allocate it to the bond space. Then only we go to the intra-asset allocation, but this two part is not covered today. Okay, so yeah, let's move on. So for the inter-asset allocation is actually on the FA side, we will need to decide, okay, by looking at some of these factors. On the equity side, we will need to look at data, corporate earnings, and valuation to see whether at this moment you like equity or you don't like. If you like, then you overweight. But if you don't like it, then you should actually underweight. So it same goes to the bond segment, whereby we will need to look at some of the data. For example, the data to decide what are the monetary policy the central banks are likely to actually decide on. Then the next one, it would be what kind of valuation, which is the credit spread that we are looking at across different market cycles. Yeah. So here are some of the sample model top portfolio that I would say the standard one. Okay. The aggressive portfolio, the allocation here I put is actually 80-20. Then on the other end, the conservative portfolio is another 80% on the debt, then 20% on equity. Then on the balance, it would be 50-50. All right. So, so actually, when we are talking about 80 20% portfolio, okay, 80% 20% portfolio, which is a conservative portfolio, is more likely and is more suitable for someone that you don't have a long investment horizon. Okay, when you cannot invest for more than 10 years and you only have a very short investment holding period, then you will definitely need it to consider a conservative portfolio. Or if you do think that at this moment the valuation of the market is the market has been going up for the past 2-3 years, and the valuation is getting more and more expensive, things are getting overstretched, and you are not feeling comfortable to have 80% or more exposure in equity, then that's the moment that you will need to go into a conservative portfolio, okay, to actually play it more defensive, like I would say. Yep. Then the next one, it would be on the balanced portfolio and whereby you balance up the thing with more equities and debt. Then the next one, it would be 80% on the equity, then 20% on the debt. Okay, so then afterwards you only think about on intra level whether at this moment how many percent of the large cap, small cap, mid cap, or US stocks or emerging market stocks with higher potential that I will need to insert into my portfolio. It's all about the allocation side. All right. So the next part we will talk about, yeah, whether when should we actually overweight, when should we actually underweight the equity. Okay, so the first thing you will need to bear in mind is know yourself and know what is your risk profile. Okay, for example, if you are someone that is around the age of 30, okay, and you still have 25 years ahead of you when you are working hard towards your retirement goal or your retirement portfolio target, all right, then you should actually adopt an aggressive portfolio model. Okay, in that sense, we should be looking at for 80 or 90% in equities. Okay, then the second part is that we will also need to look into the market valuation. Okay, the market cycle. After deciding what is your risk profile, that's the default lah. Okay, the default, you will need to understand yourself, decide your profile, then you will get a default portfolio model that you should actually stick with already. But after that, you will also need to look at the market condition. For example, if you think that the equity portfolio is actually very promising and the valuation is very low, okay, when we talk about valuation, you should actually look at the historical average PE of the market to see whether things are actually staying at what kind of level, to what extent. Okay, so the default 70-30 or 80-20 equity to debt level, 80% in equity, 20% in debt level, then you would definitely need to start trimming the equity allocation and increase, okay, and increase your debt allocation when things are getting more expensive. Okay, so for example, we look into the, oh sorry, I think I clicked the wrong button. All right, okay. So what will happen? So let's go on to the example. Okay, so for example, when the market is actually we could actually look into the market back in year 2022 when the market actually bottom, actually that time year 2022 post because early of that year the central bank, the Federal Reserve of the United States, they actually start to indicate that they actually plan to actually cut the rate, and the market start to go into a recession. If I'm not mistaken, that time the GDP data for US is also not doing too well as well. Okay, so that time the market on a broad base it actually retraced significantly lah. Okay, so that time definitely if we look at the valuation of the market, things are getting more attractive. Okay, things are getting more attractive. So if that's the case, what should we do that time is definitely we will need to increase our equity exposure and keep our bond exposure low. You can actually go as high as 70, 80 or 90% in equity. Okay, because that's the moment that you should actually grab this kind of opportunity and be friend with the volatility with the crash to actually buy the equity cheap. Okay, but when things are going positively since the end of year 2022, whereby that time when the market start to talk about the AI trend and the rise of the Nvidia and the demands of the GPU that we have been discussing, and people are actually looking at the global supplies of the AI news and things like that. It actually moved the market significantly for the rest of the year 2023 and 2024. Okay, and throughout that 2 years, actually, if you did invest into the semicon space, the return are very fantastic. Or even if you invest into the S&P 500, I think the return are actually more than 60% for that 2 years. Okay, so if you are seeing that kind of rebounds on your portfolio, what should you do? Definitely, things are getting more expensive already. You will need to start trimming your equity exposure. At the bottom of the market, year 2020, you have 80% in equity. But when things are getting more positive and things are getting more expensive, what should you do? Every 10% or 15%, you should actually trim perhaps 5 to 10% of your equity exposure. So when the market actually peak, or I would say most of the time, it's impossible for us to time when it's the peak. Okay, so we can only do it with a systematic way whereby we trim our equity exposure systematically when the market keep going up. All right, okay, so when you have been trimming, reducing your equity exposure along the up cycle, and definitely you will be managed to reduce your equity allocation perhaps to 40-50% kind of level. Okay, that's how we do it when we are talking about when we're doing it for our clients on the portfolio management. Every 10%, 15% when the market ready, we will start to trim 10% off our portfolio from the equity and switch it to something more defensive on the fixed income side, the bond side already. Okay, because what happened if the equity market, I will say when is more appropriate, because it's definitely equity market can drop 30%. Okay. So what will happen when the equity market drops more than 30%? Drops to 30% and the bond actually go up 10%. Because with the example that I showed just now, actually 9% or 10% on the bond returns are highly possible, okay? Because on the coupon is actually 5% and there's a few more percentage point adding on from the bond prices will actually spike when the market are volatile and we are facing that sort of turbulence in the market, and the market participant will tend to go into the safe haven and they will tend to seek for something that's more stable, which is the bond market. They will be rushing into the bond market. Okay, so that's the reason in this scenario I actually factor in. That's the reason why we always say bond is actually a hedging tool when it comes to equity. Okay, it's actually a hedging tool towards equity. So it could be a very key elements and exposure that every equities investor should actually put into their portfolios. Okay, so looking at the first scenario when we are talking about the portfolio A, when we are looking at portfolio A, when the equity market go down by 30%, if we have a portfolio that's with 100% stock, your portfolio will actually go down by 30%. Okay, your portfolio will actually go down by 30% as well because everything is stocks. Okay, but when we are looking at the portfolio B, which is a balanced approach with 50% equity and 50% bond, okay, things are very different. When the market tank 30%, because you only have 50% in equity, so your stock exposure only go down 50% for your whole portfolio level, okay? Because it's 50%, go down 30% is 15%. Then if you have a 50% exposure in bonds, all right, when the bond actually go up 10%, a 50% go up 10%, it will translate to a bond exposure actually help your portfolio to go up by 5%. So on overall, right, your portfolio only go down by 10%. Okay, so this is the second scenario. Then the scenario C that we are looking at when we are looking at a portfolio with 70% in bond, 30% in equity. Okay, when the market actually crash, your 30% equity exposure actually will translate to your portfolio dropping 9%, okay, for the stock exposure. But the bond exposure end will actually reverse the thing for another for 7%. So on overall, your portfolio only go down by 2%. Okay. So on the fourth scenario, portfolio D, if the portfolio is only it only have bonds inside, if the equity market drop 30% and the bond actually go up by 10%, your portfolio will actually go up by 10% now. But actually, if we do look at all these scenario, the key message that I would like to bring to you guys is that never put all your eggs in purely stocks. Okay, you will need to know when should you be adding bonds exposure into your portfolio to actually to buffer, okay, to actually buffer the downside of the market when things are not looking too positively. Okay, so if we look at the more practical portfolio B and C, right? Okay, when market is at the bottom, you have 100% portfolio with in equity. But when things are getting more expensive, you start to trim your stock exposure to 50-50 kind of level. Actually, when the market actually dropped 30%, your portfolio overall only dropped 10%. So you actually outperform the market for 20%. And imagine that in the end, okay, you are now having 50% of your bullet in the bond space. What should you do that time? Reverse the thing. What you need to do is that you will need to rebalance and sell the bond and move it to the stock exposure. Okay, sell the bond and move it to the stock exposure. You can start to increase your stock exposure when things are getting is crashing and things are getting more cheap. Okay, that's the key message that I would like to bring up. So when should we be rebalancing? Okay, definitely you should be doing it from two perspectives. Okay, the first one is definitely when market are having a significant event that is affecting your whole portfolio direction. For example, if at this moment we are accessing the US tariff that has been proposed by the Trump administration, and if you believe that this is affecting your portfolio significantly, then you should actually start to do a rebalancing. So you will need to regularly, okay, review your portfolio, perhaps, okay, on a quarterly or semi-annually basis. Okay, then the next situation is that you will also need to do it when your portfolio is deviate significantly from their target allocation. For example, okay, you are more comfortable after you have actually completed your risk assessment and you realize that you are an aggressive investor and you should have a 70-30% portfolio, 70% equity, okay, but the market have went up significantly for the past 3 years. Okay, so your 70% has become 89% after 3 years, which means that portion of equity have expanded tremendously and it become about 90% of your portfolio already. So what you need to do is you will need to trim it by reversing the allocation back, okay, when your portfolio is actually deviating from its own original location. Okay, you will need to stick back to 70-30 to make sure that if you are actually taking profit from the market and save sufficient bullet when the market are actually adjusting or the market actually tank and opportunity arrives up here. So to do it right, the first thing you will need to do is know your own risk profile. The next one is that you will need to pick the right approach, whereby do it with a systematic approach with the asset classes of equity and bonds with the right allocation across time. Okay, do it with a systematic way when the valuation is cheap, then you have more equities. When the valuation is more expensive, then you have more debt. Okay, to actually balance it out and control that kind of volatility. Because when things are getting more expensive and you have more bond exposure, actually when the volatility hit the market, your portfolio may not experience the same volatility that we are looking at from the index. Okay, the next one, it would be the long-term commitment for investors, whereby we need to stay invested, then only we can enjoy the fruitful results after the years. Okay. Yes, Shane.
Thank you so much.
Yeah.
Yeah, thank you so much, Anson, for sharing with us how do you do portfolio allocation across equity and also the debt market. If you have any question to ask our speaker today, you may write them at the Q&A box. So the first question I see is, how does inflation affect returns on equities and bonds? That's by Lim.
Okay. So I will start with the equity end first. Okay, if we look at the equity, inflation will it's actually it's actually the data, then it will affect the decision making of the central banks. Okay, on the monetary policy end. Then from the monetary policy end, it will link to whether, for example, on the bond side, then they will think about it. When the inflation is too high, they will definitely need to contain the inflation. Then they will need to have a higher rates to actually slow down the economy. This is the impact on the bond side. On the equity side, of course, inflation could translate to higher corporate earnings, but it could also add on to the risk premium. So in that sense, it would also affect when you add on to the risk premium, it will also affect the total valuation that the corporates could actually enjoy. So in certain ways, it could actually have a discount when the inflation is too high. We will actually have to discount on the valuation.
Thanks, Anson. The next question is by Eugene. So he asked a rather interesting question. So have you read the very controversial paper in finance titled Beyond the Status Quo, a critical assessment of life cycle investment advice? So basically, it argues for 100% stocks, which composed of 33% US and 67% on international stocks. So this paper has a very interesting findings. Do you have any thoughts on it?
No, I have not read this paper, but personally, I don't advocate the investors to go all in into a certain market lah. Yeah, you will definitely need to diversify globally because all the data that we are looking at this moment, perhaps the US market or any other markets that you can actually compare with, they are actually survivorship bias, whereby uh, when we are talking about US, it could be partly because of the dominance of the dominance of the US dollar, then it leads to the great corporate earnings of the US company, and but things may definitely change uh, throughout the years. So as an investor, we need to be very alert with the market changes, yeah, and never go all in into a certain market, yeah.
All right, thanks, Anson. His next question is saying that he's in his 30s. He has a very aggressive profile. So would it be fair to argue that most people don't need exposure to that instrument because we have EPF, which has close to 50% allocation to bonds, right? So what is your view?
Don't need exposure to that because we have EPF.
Yep,
Okay.
because
Um
EPF has most exposure in bonds, right? So what is your view?
EPF at this moment, if I'm not mistaken, is about 50% in bond. Mm. About 50, 40 plus 50% in bond, then the rest of it are property is only less than 10%. The rest of it are actually equity, 40 plus over in equities. But I would say in certain sense, in the reality is that Malaysian are actually very spoiled by the high FD rates, the high EPF rates that we has been seeing in the past. Okay. But uh go back to your question, you are actually asking whether most people don't need the exposure of that instrument. Okay, I will say I personally I don't agree with your with this argument is that EPF, unless you have the amount of more than the threshold of 1 million, then you have the flexibility to actually liquidate and or take out any amount from the EPF anytime. But if not, you will need to it will actually start with money until 55 years old. Then only you can withdraw any amount from it. So technically, if you want to get something that's more stable and you also want to hedge against the equity exposure, definitely bonds or debt could give you that kind of cash generating ability as well as that kind of hedging feature. Yeah.
All right. Thanks for sharing your perspective. So the next question by Kennedy is: in volatile market, which is a better strategy? Asset allocation and portfolio rebalancing versus buy and hold strategy.
You will definitely need both. Okay, you will definitely need both because buy and hold strategy, unless if you only do a buy and hold strategy, but if it's without a regular saving, what if the fundamental of the company deteriorates and things change, or the faith of the country actually change and things may be very different from year to years or decades to decades. So definitely you will need to do the rebalancing and the asset allocation from time to time.
All right. So the next question is by PK is: what are the red flags to look out for when investing in debt instruments?
Red flags, I would say you will need to look into the debt obligations that the company have and assess whether they will have difficulty on refinancing. Okay, because when we are accessing the fixed income instrument or the debt instrument, the key is about whether they have the access, the monetary access to do the refinancing. If they can refinance, actually what they need to do is actually just serve the interest. It will be okay with it. Yeah.
All right. The next question is by Sharif Razali. Where do we buy bond other than FSM1?
Currently, actually, FSM1, they do provide a low entry for normal retail investors, but do bear in your mind is that they are actually just a platform. Okay, so the role of the platform is that they onboard anything that they uh which is that they think is okay for most of the investors, but of course investors, you will still need to pick the product or the name yourself according to your own profile lah. Because definitely when we look at bonds, there are a lot of different they actually range from the safest one, the MGS, the government bond, which is close to what we call risk-free rates. Okay, there's giving risk-free rate, but the high yield corporate bonds, you can actually find bonds that is giving 10 plus over 20 over percent, but they could be at the blink of liquidation. They are facing risk of uh, difficulty to actually to refinance. Yeah.
All right. The next question here is by James. Where can we look for corporate bonds that can be invested in?
Corporate bonds that can be invested in. Yeah, the similar question like the previous one, I actually okay. So other than FSM1, you can also go to banks, commercial banks, and actually buy bonds from them. But their entry levels could be way higher, which is 250,000 for a single name lah. Yeah. So I would say the most recommended way for normal investors to go into the bond space, it would be through ETF or bond funds. Yeah, because you get to enjoy the diversification and tap into at least 50 to 100 names in the bond space and without worrying about the single credit risk that a certain company are facing and things like that. Yeah.
All right. The next question is, when deciding for a P2P lending, what are the factors that investors should consider, and whether the return from P2P lending is after the tax payment?
Okay, the key factor is definitely when we talk about that instrument, the key factors, it will definitely be you will need to look into the credit profile of the issuer. Okay, but the problem with some of the P2B lender is that they don't disclose the name and they only disclose you some of the key numbers. So that's the reason personally I don't really like to invest in P2P because I don't get to do the research myself. Yeah. So you will this could be factors that turn me off lah, I would say. So because anyhow you will definitely need to look into the credit profile and look into whether which industry the issuers are actually is actually from which industry, because which industry also directly tell you what kind of risk that you are actually facing, right?
All right. Thanks for sharing your perspective, Anson. So the next question is by Siu Wai. How should we include digital assets in our investment portfolio?
Digital asset in our portfolio, you should be talking about cryptos. I guess, okay, if we are talking about cryptos, then the most recommended allocation at this moment for most of the retail investor, it could be only 5 to 10% in your portfolio. But of course, it depends on to what extent you understand about cryptocurrencies. Because at this alternative investment space, things are very different compared to the basic asset classes that we are discussing today, like equities and debt, because there's no the selling point of the digital asset, it could be on the technology or some of the back end securities that they are actually putting up for the digital assets. So it really have to judge based on the asset itself lah.
All right. So the next question is: are there life stages where one should prioritize debt over equity, or vice versa?
For example, most of the time when I'm doing financial planning for my clients, we will first look into their retirement magic number. We will need to identify how much retirement funds that they need for their retirement. So, for example, if they are approaching their retirement age already, and if they already have enough, okay, they already have enough, you will need to know what's the end goal. Then you will see whether what you have at this moment is enough to hit your end goal or not. If it's not enough, then you will need to look at taking more risk on the equity side, whether it makes sense or not. If it doesn't make sense, then you may need to adjust your retirement goal and or the standard of living that you have after your retirement. But most of the case, like your question is that when the life stages change, when you're approaching the retirement, the most recommended way is for most investors is that they if the planning has been done well, right, you should actually turn most of your portfolio, I would say majority of them, into the debt element. Okay, the debt instrument to collect the cash flow and put on the stability in your portfolio.
All right.
Mm.
The next question is by Sharif Razali. I think he means that is investing in P2P tax deductible? If it is, then how much?
This question I'm not too sure because I only invested into P2P one or twice only. Yeah, I'm not a regular investor of it.
Mm-hmm. All right. Yeah, if any question, ask our speaker, please write in the Q&A box, yeah? So how do you approach someone who are young and they are just starting in their financial planning journey? Would you advise them to have a more aggressive portfolio?
Um, for the scenario that has been given by you, I would say yes. Okay, but they will need to know what is the end goal and figure out what kind of number of the monthly savings they should actually put in to their portfolio on a regular saving basis, then build it to the end goal. Yeah.
Mm. So do you have any recommended portfolio for retirees? Is a balanced portfolio good enough?
Normally retirees we will go for conservative
So
unless
more
the
bonds,
money are more bonds, 70-80% in bonds, and they only tap into the market if the market crash up. But they only tap with perhaps 10 or 20% of the portfolio
so
to
in
get the
your
extra monies for
so
market.
in your experience watching both bonds portfolio and equity portfolio over the past, I guess, decade in this
Mm,
financial planning industry, usually when the stock market tank, right,
mm.
do the bond market go up?
I would say 90% of the time. The only exceptional time that I remember is actually year 2020 for 2 months. Actually, that time when the COVID hits the market, market actually have that sort of liquidity issue whereby everyone is like, oh, they want to sell off their financial asset, be it equity and be it bond market also having the same thing. But after 2 months, then things start to normalize and bond prices pick up significantly already.
Yep. How about this Trump reciprocal tariff period?
Yes, bond
Like we
prices
know that the
do
US
went up.
bond was sold, right? US bonds were sold, right?
Correct. And the Asia market, and you can actually see when our currency ringgit has been strengthening, and but the foreign investor, they are basically not going into the Malaysian equity market, but they are actually going into the Malaysian debt market. So
Oh,
that's why the bond pricing has been quite resilient for the recent months.
so there's an influx of investment into the Malaysian government securities, lah, right? Malaysia
Correct.
bond markets. Okay.
Mm.
All right.
Then I would say, looking at some of the economy data that we are having in Malaysia, Bank Negara should have a good chance of cutting interest rate moving into the second half of the year. Not
Mm,
sure whether it's the July one or the next one. Yeah.
mm, okay, but US hasn't moved yet, lah. Do you think Bank Negara will move earlier than the US?
Looking at the consensus at this moment that I just see a few days ago, market is about 60-40. 60% they think second half will cut for Malaysia. Because I think the key concern is that uh they don't think Bank Negara will let ringgit strengthen for too much lah. Yeah, because anyhow our nation are actually a export driven country.
All right. So the next question is, what about um, considering foreign currencies into our investment portfolio? What is your view?
Yes, okay, but you will definitely need to answer the following question is that what would you do with your money? For example, if you are telling me, oh, I will just convert everything into Sing dollar or US dollar and put it in the FD versus putting the money into the FD in Malaysia, then I would tell you the answer is actually you no need to diversify to another currency. Okay, because ultimately, if you do a research and compare, okay, the currency differential between ringgit and Sing dollar actually has been compensated and offset by the differential between our FD rates throughout the years, whereby throughout the years, Singapore SG FD rates are somewhere about 1+% that kind of rate compared to our 3+4% and half rate. It actually offset the currency depreciation of ringgit. So you will need to know what should you do with the money after the conversion? Unless you are talking about, then if that's the case, I'm investing into equity, then it makes a sense. But if you are having a conservative portfolio, you are only do it on a saving perspective, then it doesn't make the sense by trying to take advantage of the currency appreciation of a certain currency, then you want to diversify into a certain currency, it may not make the sense over there.
All right. Let's do one last question by Laura. Is stablecoin a debt instrument as pegged against currency?
No, a debt instrument, you will need to come with uh the cash generating feature. But of course, some of the coins they do have the stacking feature whereby they will yield some of the new coins but it will need to judge from case by case.
All right. So thanks for all your questions. That's all the time we have with our speaker today, Mr. Anson Tan. So thank you everybody for tuning in to this webinar. So you just listened to the co-founder of BBB Wealth, Mr. Anson Tan. Thank you so much, Anson.
Thank you, Shane, for the invitation.